Understanding Passive Investing, a comprehensive guide. Passive investing is an increasingly popular investment strategy that aims to maximize returns while minimizing trading activities. This approach focuses on long-term investments and maintains a buy-and-hold philosophy, often using vehicles like index funds and exchange-traded funds, ETFs. In this article, we will delve deeper into the principles of passive investing, its benefits and drawbacks, how it compares with active investing, and how you can effectively start your journey in passive investing. What is passive investing? Passive investing broadly refers to a buy-and-hold portfolio strategy for long-term investment horizons with minimal market trading. At its core, passive investors believe in the market's capacity to post positive returns over time and, rather than attempting to beat the market through constant trading, they seek to replicate its performance. Key characteristics of passive investing. Buy-and-hold strategy. Instead of frequently buying and selling securities, passive investors acquire assets like index funds and hold them for a prolonged period. Market replication. The objective is to achieve similar returns to a specific market index, such as the S&P 500, instead of outperforming it. Diversification. Passive investing often involves broad diversification, spreading risk across various securities, which lowers volatility and enhances stability. Benefits of passive investing. 1. Cost-effectiveness. Passive investing typically incurs lower fees than active investing. Since there are no professionals actively managing the fund, researching stocks, timing trades, etc., operating costs are lower. According to reports, in 2020, the average fee for actively managed mutual funds was approximately 0.71%, while passive funds had an average fee of around 0.06%. 2. Tax efficiency. Passive investment strategies are less likely to trigger capital gains taxes due to their buy-and-hold nature. This can lead to better after-tax returns compared to actively managed funds where frequent trading generates taxable events. 3. Transparency and simplicity. Investors in passive funds can easily understand the underlying assets and the structure of the fund. There's no need to monitor individual securities or managerial decisions, making it simpler for investors to manage their portfolios. 4. Consistent performance. Research shows that passive funds often outperform their actively managed counterparts over the long term, largely due to lower fees and expenses. Drawbacks of passive investing. 1. Market risk. Passive investing exposes investors to overall market risk. While funds are diversified, when the market falls, so do the index funds. This makes passive investments less suitable for those seeking protection during market downturns. 2. Limited flexibility. Passive funds are restricted to specific indices, meaning that managers cannot adjust holdings based on market conditions. If particular sectors perform poorly, investors are locked into those holdings. 3. Dependence on market performance. Passive strategies are designed to track the market closely. Therefore, although they can replicate returns, they are unlikely to outperform, especially during market booms where active managers might capitalize on volatility. Passive versus active investing. Contrasting passive investing with active investing highlights a spectrum of investment strategies, both of which have their pros and cons. Active investing. Active investing involves the frequent buying and selling of securities with the goal of outperforming a benchmark index. Key benefits include flexibility and opportunity. Active managers can respond quickly to market changes, potentially capitalizing on temporary mispricing. Risk mitigation. Active strategies can use hedging techniques to reduce exposure to downside risk. Customization. Portfolios can be tailored to meet specific investment strategies or risk tolerances. However, active investing comes with its challenges, mainly higher costs. Increased transaction fees and management expenses can erode profits. Greater risk. Actively managed funds bear the risk of underperformance compared to passive strategies. Poor track record. Historically, many active managers have failed to consistently outperform their benchmarks over long periods once fees are considered. Getting started with passive investing. If you are interested in passive investing, consider the following steps. 1. Research index funds and ETFs. Identify funds that mirror indices you are interested in. Look for low expense ratios and good performance history. 2. Open a brokerage account. Most investment platforms allow you to buy index funds and ETFs, offering a convenient way to start investing. 3. Diversify your portfolio. While passive investing encourages holding broad market indices, consider diversifying further within asset classes, e.g., stocks and bonds. 4. Adopt a long-term perspective. Remember that passive investing thrives on long-term growth. Patience is vital as markets fluctuate. 5. Monitor costs and performance. While passive investing is low maintenance, it's wise to periodically review your investments for cost efficiency and alignment with your goals. Conclusion. Passive investing presents an effective strategy for individuals seeking to build wealth over the long term with lower risk and less complexity. Despite its limitations, such as exposure to total market risk and relatively lower short-term returns, its cost-effectiveness and simplicity make it appealing. Whether you are a novice investor or someone looking for a hands-off approach, understanding the fundamentals of passive investing can serve your financial objectives well.